Oh, and I have a doctor's appointment today too to add to the madness. All right.
You know what I'm
We
doing tomorrow.
should be live. What's that?
I'm not saying it live.
That's why I
I have
interrupted
an
you.
I have a doctor appointment as well.
Okay. All right. Tell me about it
Fun,
later. All
fun
right.
stuff. Yeah,
Nick.
nothing bad.
Okay, good.
Yeah.
Um, all right. Welcome everyone. Todd and Kyle here. We'll get started in about probably 20, 30 seconds here. Let me just confirm we're streaming on all platforms and we'll get rolling here. Let's just make sure. I believe we're good. I believe we're good. Yeah, I think so.
Love it.
Yep, looking good. Both platforms. Um, so we're gonna I would say this is the second week that we've been able to stream to both YouTube and within the private area at Inside Edge for investors. And I'd say next week, Kyle, we're going to have the traditional countdown timer live, and we'll roll right in without all the rambling in the beginning. But we're making progress, right?
Yeah, we're here. No difficulties.
Yep.
Love it.
Um, Okay, sounds good. And also, if there's a echo, Nick, please let me know, and I'll throw headphones in. But yeah, this is what a somber. We were just writing on our team Slack. What a bummer of a day. 24th anniversary of September 11th, and then horrible political assassination. On the 249th year, a little bit of echo. Okay. 249th year. Did you know next year's our 250th, Kyle?
I did. Yep. Can't wait to celebrate that, but I'll echo what you were saying, and hopefully I'm not echoing still, but
Yeah, no,
um
I'll
yeah,
here,
it's
I'll
just
take care.
the sad day and the anniversary of 9/11 also very sad. I mean, you're in New York. My dad was working at Fiduciary Trust at the time and had actually gotten laid off a month before 9/11, and his secretary was working and called him that morning, and asked if she needed to go to this meeting that was in the towers.
Oh,
And he said, no, that's probably not an important meeting. Go ahead and skip and go get coffee. And so that's that. And I knew her well, Shelly. And so she called him as it was happening and just like, hey, this happened. You saved my life. And obviously he knew, I'm sure you did too, but
oh,
very, very somber day. And yeah, it just shows how important it is we use the time we're here wisely. You never know what's going to happen, and so it's a sad but a reminder to bring
well
some
said.
good into the world and do good.
Well said. Yep, absolutely. And it's somewhat it's annoying's not the right word. It's disconcerting. I don't know. There's so much I would say just malaise, and so it just horrible human events overshadowing the productivity that this country is achieving. It's bittersweet. Why can't we focus on what a beautiful country and the way capitalism is propelling and the innovation that we have and the value creation that's happening? It's like we just had an unbelievable report out of Oracle, markets at all-time highs, and we're talking about human tragedy. So with
Yeah.
that, let's push on here. But well said. And boy, you never told me that story about your dad.
Yeah,
That's
so it
that's
was the best layoff he ever got, I guess, in terms of because he was in LA but flying to New York every week, so it was
yeah.
New York every it could have been worse for.
And I had nowhere near that. Um, I had just taken my first trading job in San Diego. I moved out in July. I was studying for the Series 7. I was set to start trading in October. So as soon as I got there on the West Coast, 9/11 happened. And I just felt, oh man, thinking about all my
Yeah.
friends back home. So anyway,
Yeah.
let's get rolling. We got content to deliver. The show must go on.
Mhm.
Humans will continue to be wildly imperfect and continue to make mistakes, but our innovation uh, pushes forward. So, you like what I did there? Normally, we have the picture of the beautiful peak, symbolic of inside edge, but that picture fit in pretty well.
Yeah. Good
Um,
memories.
Okay, so Oracle, we're going to talk about that economic update coming up on a Fed rate cut, housing update, Chinese markets, very much related to what's going on in the Fed rate policy. A lot of fun stuff happening in the markets. The other thing I should mention, and we will roll into the client only. Let me go back here. Sorry, the client only portion. I am neck deep in a portfolio reallocation, and what we're going to do in the investor only section is take you through and show you how I go through and look at the market as a whole, break it down into the sectors, and then go for the individual equity selection, both technicals and fundamentals, that stocks that I look at that are good enough to be in our portfolios. So we're going to talk about that. We're right. I thought I would have the portfolio reallocation done for today and present to clients, but we have them not quite done yet. Have growth done. I need to continue to power through on SIG, which is our dividend, but it's something that we will share on the public. And I'd like to uncover it over a period of time and show you how we approach that. So that's going on. And then Kyle, like on top of all the emotion, and I'm sorry to be, emotional about this, but I just hate when shit like this happens. This is so annoying. I'm going out to Martha's Vineyard tomorrow, and my best buddy growing up, he had a baby, and I'm going to be a godfather. So,
Wow. Love that.
yep. All right.
Congrats.
Thanks,
Congrats
man.
to your friend. Yeah.
Thanks, bud.
That's awesome.
All right. So all kinds of stuff going on. Oracle was just, it was unbelievable what they did. I mean, the numbers that they put out there in terms of expected cloud investment over the next several years, people had to do like a double take. Oracle put on, we have market cap slides coming up. Like top line revenue was fine, EPS was a beat, but the projection was massive. So this just like when everybody, including us, Kyle, when we thought seasonalities were going to take over, it's time to get protective. Oracle comes out and tacks on almost 40% share in one day, 35.9. Like it's almost $1 trillion company. We went from, I don't know, it's the next slide, 500 billion to 7, 8, 900 billion on the way to $1 trillion market capitalization. It's just absolutely massive. So it's
Yeah.
one of, just kind of looking at this, this is out of the Wall Street Journal, one of the largest cloud contracts ever signed, the equivalent of 4.5 gigawatts of power, which is the equivalent of 2 Hoover dams, to be consumed by 4 million homes. Oracle surged 43% as it added 317 billion in future contracts. OpenAI was a big mystery customer of Oracle. And what I did here is I just showed you Oracle revenues going back to 2020 compared to NVIDIA revenues. Now we're right here, right? This is 2024. This is 2025. This is projected to 2026. You could see where, the shareholder returns that have been generated in NVIDIA in gray are massive, but I think even more, Kyle, look at the projections going forward. Yeah, I mean, maybe the market is discounting 1, 2, 3 years into the future. But, again, NVIDIA has been such a massive return based on those gray expected revenue. Oracle just joined the party. And look how I would say more shallow the revenue projections are with Oracle in 26, 27, 28, 29, and 2030. Thoughts about that?
Yeah. I mean, they're earning the hyperscaler tags. And then, Oracle had been kind of dead in the water for so long. Not, I mean, not literally, but not really talked about. So for it to come back like this is a good sign for this AI build out.
And I have it right here. So this is not the share price, but this is market capitalization. Like what's amazing about this and Larry Ellison, which he's got to be, how old is he? 70? I don't know. We should look it up, but
Yeah, I
uh
can look it up.
yeah, I mean, but look at this is the second, not only the second coming of Larry Ellison and Oracle, because obviously they were there to build out hardware infrastructure in the early internet coming online in 2000. We went up to $250 billion market cap, which, I hate when people call it the internet bubble. Well, it was the internet launching. It achieved the bubble status, collapsed, and here we go again. Take two with Larry Ellison and Oracle. Look at the market capitalization. This is a monthly chart going back to 1990, so that is 35 years. This is year to date. We went from a $600 billion market cap to $922 billion in one day. And it's just be careful. The revenue, again, what I was trying to bring out in the past is these aren't 1999 valuations based on revenue that is not coming in. The revenue has materialized. Yeah, there's a lot of valuation coming forward based on. There's a lot of risk with this as we price in 2-3 years in the future. But with widespread application of these technologies across all industries, that revenue probably becomes, I would think, becomes realized, and that's how the market is trading. How
Mhm.
old is Larry Ellison?
81.
81. He's got an 8 handle.
He's in his 80s. Yeah.
Wow, dude.
He doesn't
I
look 80.
No, he doesn't. Well, he's the richest person in the world. Like, he probably can pay to look
Yeah.
50. Looks
Got
looks
a
young,
good
looks younger than I do.
cosmetician or whatever they're called. Yeah.
That's funny. Um, All right. Also, news. This was a big one. Producer prices came in negative month over month at the core, and at the headline also negative. Expectations of 0.3 came in at negative 0.1. There was a prior revision down. I think it was 0.9% in the July readings. We just reported on August. July was, I believe it was 0.9 in both. They were revised down to 0.7. And then this one, the producer inputs hit negative. And that really jolted the market and started to show that, we're almost guaranteed to have a rate cut coming out September. We just got CPI, so PPI is producer, CPI is consumer. As expected, the month over month was 1/10 higher in the headline. I have to admit, I did not have time to look into the components of why that was up. Just jam time for this presentation on the other stuff. I'll come back to you on that, why we missed on 1/10. I'm curious to know, and I'll
Mhm.
update you. But so we're at 90%, Kyle, of a rate cut next week on the 17th. 90% plus
Or
9.2% equals 100%, eh?
yeah, it looks like it's happening.
So what do you
And
think? Talk to me. Are we gonna get 2 or 3 rate cuts this year with the market exploding higher?
odds are three. Looks like.
You're gonna bet
Looks like.
3?
Yeah, and that I mean I'm literally going off the odds here. I mean, I think that it would be appropriate, and I think that even if inflation kind of hovered around where it is now, you'd still be about 1% above inflation, or maybe 2/3%, which I think is totally appropriate for Fed policy.
I mean, dude, they're gonna cut 3 times into a tech bull market with real profits being made. Like what? I mean,
Yeah,
this could get crazy, man.
it could, yeah, and who knows what'll happen. I think on the demand side it makes sense, but yeah, to your point, like as far as markets and prices and price stability, I think that could definitely keep keep going.
So, and this is a conversation we're going to have with clients when we get off, but we can have it here. Like you and I have been talking a lot about this. Like on one side, based on what we just said, foot on the gas pedal, and we could freaking go parabolic. I mean, we could rip into the end of the year, but there's also concerns. Why is the Fed despite the obvious tech build out and the amazing earnings we're putting out, the economic slowdown via the employment market softening, we're seeing interest rates drop. Is there a message that's being told of economic weakness that we need to be concerned about? Plus the seasonalities that you and I have already talked about a couple times this week. So what we're coming into is, yeah, we're kind of straddling the fence, and we are not only trading the markets, but we're trading our clients. And what we mean by that is, yeah, we want to get more aggressive and almost increase the beta of the growth portfolio, which is tag, because more of our investors who have a longer timeline and a higher risk appetite, or I think we can, that's part of the financial plan where they want to try to exploit the upside, but the volatility that is inherent with that is acceptable. The other clients that we have who are later in their years, closer to retirement, don't want the volatility. On the other side, the concern that we have, we're trying to kind of dampen the volatility or the beta or reduce the aggressiveness of our SIG portfolio. So it's like we're trading the models, and it's a conversation we're going to have with clients, but pull together what I'm trying to say, please.
Yeah, it's kind of the combining, and every client is different, so it's combining kind of our endless pursuit of outperformance with letting
Whoa.
our different, yeah, right,
That dude,
with our,
Nick, mark that at 12:17. That's going to be a clip going on social.
yeah. So that's one end, and then there's a behavioral aspect to investing that we're totally aware of with our clients. We work with people who have different behavioral investment styles and biases, and there's plenty of people out there that would accept a lower return than the S&P to also lower the volatility of their investments from day to day. So we have to be working for both groups of people, and that means providing different investment solutions where some of them are endlessly pursuing that outperformance, and while our more conservative model, we love it to outperform too. If we get into a period where looks a little extended, there's some risks out there that have kind of emerged that we want to specifically protect against, then we're more likely to do that in those accounts. I mean, we'll do
Yep.
it in the
Yep.
aggressive account too, but we have to manage different styles of investor as we go through these market cycles, which you should expect to get highly volatile, at least, I would say once a year.
Right. Okay. Good. Well said. Well
So if you
said.
want to, yeah, and
Yeah.
if you want to be a long-term investor, you want to be able to navigate through those periods of volatility, and the
Yep.
and the best way to do that is to like have a goal-based plan, have a risk tolerance in place, and use all the information you can to make an educated decision on how you're investing. And that, I mean, that's what we're all trying to do.
Yep. Well said. All right. We'll come back to that. We'll talk more about that, but good stuff. So, we talked about this last week as we're heading into the September 17th Fed rate cut. We're also seeing long-term yields break down. So this is the US 10-year yield. This is the kind of, I call it like the Chevrolet interest rate. It's kind of the heartbeat of America. I don't even know if that was the Chevy commercial. The heartbeat. What was it? You're probably you're too young to
I
probably
might,
remember.
you, yeah,
You're too young.
you're,
Heartbeat.
yeah.
I forgot what it was. Uh, if John P is listening to this, who's a
The
client,
one in
he's gonna yell at me. I should know this. He usually listens. Anyway,
in
so
Texas, it's Chevy. That's what I like about Texas.
don't ever sing it, Ken. Holy cat.
I'm gonna sing every stream now.
All
Too
right.
late.
All right. All right. So US 10-year yields breaking down. You'd connect these two significant lows, and that's deemed to be a floor of support. And we just kind of gap through it. So we're at 4.013 in the 10-year, and I'm saying it's the Chevrolet interest rate because this one has the biggest impact, and all interest rates that filter through the economy, housing and asset purchases and credit cards and blah blah blah. So what we'll come back to that. What is it going to do? We'll see. It's broken support. Again, is it a economically bearish signal, or is it reflective that interest rates that were abnormally high post COVID and pandemic are mean reverting or coming down and are adjusting to where they should be, even with the health of the economy that arguably we have. Market technicals. Again, I'm just gonna give a nod to the people who know me from my old life. Those of you who are new clients of Inside Edge and never saw us at Trading Analysis, you don't know what I'm talking about, please disregard. But those of you who know me from the old days, here's what we're looking at. Real quick, S&P 500, 2024. Here is the early 25 sell-off. V shape. We came ripping back, broke the old highs. A typical ratio extension. Basically, the rule of thumb is when you break the 78, this is basically 3/4 of a retracement. This is your target, the 1272. All that means is whatever percent decline, $613 to 482, you multiply that by 1.272. Again, you're like, probably, what are you talking about? It's voodoo stuff that actually works. This is the target. We're here. Now, it's interesting. The next kind of rule of thumb is if you don't stop at this one, this is the next ratio that you're going to target. I mean, that's a long ways up. Now, this is 654, 660 in the S&P. This is a weekly chart. Each one of these candles is a week of trading. This is a daily. To get a little bit more granular, around that 654, which is right here, there's a little Elliott wave pattern basically that says this is resistance. This orange, yellow oval, this is resistance. We based on this assessment, this is a sort of a quantitative look at the market. We can't break above this. While we're below it, it says we do have the possibility of a decline. Okay, while we're below 6.6, I can't even see it. I hate to say it, but that's 666. While we're below 666, there is still a possibility of a decline based on this analysis. On the weekly, this is significant resistance as well, 654. So we have to be on watch. As good as things feel right now, these two charts say this resistance is real. If we break above this orange, yellow oval, we're probably going higher, and this analysis is all wrong. Disregard it, and the trend is still up. Okay, that's what all that means. This is an ending diagonal. Again, for you Elliott wave geeks like me, 5 can't be longer than 3. That is true while we're below 666. Okay, so up, but this is a key zone of resistance as we head into next week's rate cut. Housing rate cut. Housing and mortgage rates. So as we've been focusing on the 10-year yield, which on this chart is in purple, 4.08. Economy is the housing market, which refis and mortgage originations at these levels are just not doable for most people with the levels of disposable income. So the housing market, they're saying, is choking, is a contributing factor to choking off the economy. So you want to look at the spread between the highly determinate U.S. 10-year yield and 30-year mortgage. Okay, it doesn't make a lot of sense. Why would 10-year yields have such a big impact on 30-year mortgage? But you can see going back to the 80s, there's clearly a very strong relationship. And below here, you're measuring the spread. What's the difference of 30-year mortgage compared to the U.S. 10-year yield? And this blue chart is the spread. The low is all the way back here in the 80s, 4.84. I don't know offhand what the credit crisis low was. And again, that means the treasury yield was this much lower than mortgage, right? Banks require this much excessive cost for investors to borrow to justify the risk they have to take to write mortgages, right? We came off a pretty low level of 3.2%, which looks pretty close to that credit crisis low. That was the widest spread, believe it or not, right here. We've come up off those lows. We're at 2.33% difference between U.S. 10-year yields and mortgage rates. And if we could close up that difference and get to the long-term average of 1.82%, that would be 50 basis points, either 50 basis points lower in mortgage rates or 50 basis points higher in 10-year yields. Either one would make the long-term average, become our current level. I have to think, and I hope mortgage lenders would take 50 basis points less of a risk, less
Mhm.
payment, I would say, to take on more risk to write mortgages below 6%, which would be a five handle. Kyle, I think that would go a long way with kind of psychology and sentiment if people are paying 5%, 5.8, 5.9 for a mortgage rather than 6.5. What do you think?
Definitely, it would help on the consumer side, kind of help things pick up. It would be because part of that premium is based on inflation expectations and the chance that you write a loan and then try to write a loan tomorrow and it's more expensive with rates being higher. So then you're making less on this other one. So as we kind of mentioned last week, like inflation expectations going down, that should suppress the spread. If you think inflation is going to go up, or if you're a originator thinks inflation's going to increase, you're going to want a bigger spread, which is what we saw in kind of the aftermath of the 2022 there, where the spread just accelerated as inflation rates also went up.
Very nice. All right, let's add housing on top of this. As hopefully this spread, which is 2.33% difference from 30-year mortgage and 10-year yield, comes back up. The average here says it's minus 2% because we're looking back to 16, so it's a shorter time frame. But I added XHB, which is the ETF for housing. Now, what's interesting is I'm doing this rebalance, Kyle. And I don't know the answer to this yet. I'm finding fewer and fewer candidates within consumer discretionary stocks that are worthy of inclusion in our portfolios, with the exception of housing. So I'm seeing consumer discretionary stocks kind of favor or kind of fade out, but home builders are starting to come back on. So
Hmm.
is that a defensive signal? Because if you go to economics class 101, or I don't know, 401 or whatever in college, they'll say real estate is a counter-cyclical market. Are we starting to see signs of that? Because again, a lot of consumer discretionary autos and leisure hotels, autos are kind of falling out of favor, but housing's coming in. So I'm like, ugh, do we love that message? So XHB in green is starting to move back up at the highs as the spread between U.S. Treasuries and mortgage rates is coming off, which obviously that means mortgage rates are going down. So we'll just keep an eye on that. Related, go ahead. Chinese stocks. We're seeing a rotation into China. Kyle, start us off at the top, and we'll put some charts and show you some pretty pictures behind this.
Yeah, so the Shanghai Composite Index, it hit a 10-year high back. You have to go back to 2015 to find kind of this spike in values that happened then. Attributed to the ongoing government stimulus that China enacted in, I guess it was last year,
Yep.
directing stimulus to consumers, businesses, home builders, home and business uh, building builders, and so that has been huge for helping the recovery, as there is like a consumer demand lagging there with the citizens of China, and they've also done some interest rate cuts. They lowered their reserve requirements, which allowed the banks to invest. I saw it's not listed here, but it was a trillion won into the market. Regulatory easing, um, attractive valuations after several years of negative performance, where companies may be making more money, but due to pandemic or over regulatory or external risks, the prices of those stocks didn't increase because there was other stuff going on other than their balance sheet. And then I also note that foreign flows of investments to equities turned positive in the fourth quarter of 2024.
And that's right behind our heads right here. Sorry. Foreign flows to Chinese
Yeah,
equities turned net positive in Q4. That's an important point that, sorry, I'm hiding that text. I didn't mean to interrupt you. Sorry.
no, that's fine. I'm moving it up right now.
Oh, there you go.
Yeah,
Nice.
here we
Um,
are.
all right. So, you know, I think I explained last week, I consider myself and I think Kyle is, even though his dad does it as well. He's a technical analyst as well. I'm trying to make you more of a visual investor rather than a data driven investor. And both are great. So what we're looking at here is the FXI. This is the ETF that tracks large cap, not mainland China, Hong Kong stock exchange, HSC, large cap. I think it's 20 or 30 of the largest stocks on the Hong Kong exchange. So that's FXI. And the point of showing you this chart is, I kind of laugh when money managers say, well, you got to diversify overseas and be in emerging markets. Well, half of it's Asia, Japan, China, and Korea. They've been underperforming since here, 2009. They've been underperforming US since 2009. So, whoops. But you just become a visual investor and you start to say, okay, when can I really start to see some concentrated flows, rotation out of the US overseas, such that the returns overseas are starting to outpace those in the US? And you don't have to be the first one in to gain a good return or an alpha. You have to watch what's actually happening. Is there starting to be signs of a rotation up, or a move up out of Western equities into Eastern equities? Possibly, because this is basically the ratio of FXI to SPY, which is the S&P 500 tracking stock. The red line is the moving average of the relative strength ratio. If this turns up, that means China is outperforming the US. From a technical point of view on FXI, we have a long way to go until you would say it's a technical breakout that's breaking through the trend line. There's certainly possibility we move up here and fail. Okay. So this is going back all the way to 2005. This is the daily chart. So this is going 23, 2024, 25, and into 26. So this is basically this guy right here, zoomed in. And you can see, yeah, we are over the last year and a half, we are on the whole relative to the S&P seeing outperformance of Asia, specifically China, into the US. Now, this is the S&P. The S&P is only 35% technology. Of that, semiconductors and hardware and now software are really putting a lot of the outperformance out there. But the S&P covers the whole American economy, right? So if you were to do it over the NASDAQ or specifically semis, it wouldn't look like this. This is the whole S&P. But yeah, compared to the whole S&P, we are starting to see some outperformance in China. So I'm watching this. Okay. And a big reason, one of the reasons, Kyle showed how China and those micro fundamentals, there was stimulus, there is economic growth. They're trying everything they can. They had a huge housing property crisis. They're trying to stimulate the economy from within China. Yeah, we are starting to see some foreign flows, but there's also a big impact of China based on where the Fed sets our monetary policy and where our interest rates go, and related where our US currency goes, because the Chinese currency, the yuan, is still pegged to the dollar, trades within a band to the US dollar. So, where our dollar goes relative to other currencies around the world is a function of where our interest rates go, and that's a larger discussion. I used to trade for an FX fund, so interest rate differentials is what creates capital flows from one country to another. And so basically what I'm showing you here is, as our US yields are dropping, we've talked about it a bunch, you're seeing a equal, not an equal, but an opposite, and I would say more ferocious move up in China as the US is getting ready to start dropping interest rates potentially 3 times this year. So it's coming from outside force out of the US monetary policy, but also domestic stimulus and perhaps improved growth within China. So it's something that I'm very much watching. For you traders out there, this is a software that I came across probably a year or maybe two ago. I've just gone head first in it, deep view. It has changed the way I look at markets. Like I can't even begin to tell you how, just involved this software I am. It's awesome. But anyways, what we're looking at here is um, Chinese stocks. I think it was $1 billion market cap or more. There's market cap. I know it's really small. I sorted by percent change on the year. And then these are some of the proprietary rankings. It's very similar to like IBD, Market Surge, the composite rating, the fundamental rating from a scale of 0 to 100, the sales rating, how quality are the revenue numbers as well as EPS. So you can see from a scale of 0 to 100 on comp, 3, 6 months, fundamentals, sales, EPS, and then sorted by percent change. This is a place where you start to find candidates that you might want to trade. And I've highlighted Tencent, a company I'm sure that you know, a $40 billion market cap. Here's the monthly chart of Tencent coming up on all-time highs. They're about $32, $33 on the monthly. Here's a nice, what we call a little bull flag on the daily. I need to look more into this, but I am considering adding some Chinese exposure to our portfolios. And this is just the first step in the process of finding some of the stocks you want to look at. And if you're interested, here's a big list. And I'll tell you right now, we are going to add in the dividend, this guy right here, Kyle. We're going to add net ease. It pays I forgot the dividend, but it does pay a yield. Fundamentals have been strong. It was mentioned in the Apple conference call, or not the conference call, the event that Tim Cook just did with their gaming. NetEase is, it's a not a crazy beta, reasonable stock with a dividend that we could place in our dividend portfolio. So just a heads up.
Cool.
All right. Closing thoughts before we go to clients only.
Uh, I don't know. It's going to be an interesting month. I feel like this month is just there's going to be kind of an updated projection at the end of this month or this year. I feel like we're going to get some confirmation on maybe how the rest of the year will go, or maybe we'll get another shakeout like we did last August. So we'll know sooner than later, but I'm curious to see how this month goes.
Yeah, that makes two of us. And we didn't even mention that it was the biggest job revision out of the BLS, ever. People
Yeah,
look at our jobs number like, that's all right, don't worry about it. We're going to revise next month. Well, thanks a lot. That helps.
yeah,
You're right though.
but
It's going to be an
we'll get
interesting
it right.
month. We're going to be
Yeah,
we're going to be plugged in. So anyways, hope that helps. Inside Edge Capital. I'm Todd. He's Kyle. We're digital wealth management, active portfolio management, comprehensive planning together. I think it's a winning combo, man.
yep.
Uh,
Goal-based planning.
yep. All right, we're gonna head in. I'm gonna turn off YouTube and the Twitter somehow. I'm gonna do that, and we're gonna go and talk to our clients. All right, guys. All the best. Thanks for joining, and we'll talk to you soon. Clients will be right there.